So marginal analysis pricing, market comparables. So pricing of the product using market comparables or competitive pricing. This is a competitive pricing because market comparables means we are offering a product and the same similar product is offered by the market competitors. So competitive pricing model involves setting a product price or a service price, okay, setting a product price or service price by referring to the similar offerings in the market, by referring
Okay.
similar offerings, okay,
Okay, sir.
in the
Understood.
market. So
Market.
we are thinking about the,
Like biscuits.
we are gathering the matters information related to the our competitors and how they are making the price, deciding the price. So that strategy provides us a valuable informations such as, first point is external reference point. So competitor prices serves as an external benchmark, right? So
Yes, sir.
external reference point for us. So the competitor prices serves as an external benchmarks, helping the management assess how their prices compared in the industry, compare in the industry, how the prices are there in the industry. So this is external factor, external reference point. Another one is value reflection. Another one is value reflection. So this value reflection means by aligning the prices with the market comparables, our company can ensure its prices reflect the, perceived value of its product or a service within the market. So attracting the customers without pricing too high or low. We are not increasing the price or we are not decreasing the price. We are making the similar price. For example, you have a
Okay.
product like Maggie, okay,
Yes,
and you
sir.
have another noodles from the ITC. What was that? Ippy
ITC.
noodles, right?
ITC. Yippee
Yeah,
noodles. Yes,
Ippy
sir.
noodles. So these are the similar products, right?
Almost same price. Just
Yes,
1 rupee
almost
idhar
they will
udhar.
make the same price around 12 rupees or maybe 11
And
rupees,
11.
okay, or maybe 10
11.
rupees. So similar, if the
Yes.
Maggie is providing at 12
Yes.
rupees and previously EP was providing it $10, the 10 rupees price, now they will make the price to near to 12, not much lower and higher, correct? If the customer is wants to buy a noodle packet, instant noodle packet, they can select
Correct, sir.
anything
Hello?
because, yeah, can you hear me?
Yes.
Yeah, because of this
Yes,
what
sir.
is happening, the
Sometimes the
value
network is going.
reflection is happening, right? Because
Value
of this value
reflection. Yes,
reflection
sir.
is happening without pricing too high or low, correct?
Correct.
So now makeup, now we will go to the makeup price method, okay. See,
Okay.
what is the makeup price method? Cost based pricing is also there, that is the makeup pricing. So
So cost-based pricing is only known as makeup pricing.
hmm, the makeup cost plus pricing or makeup, two things. Cost based,
Cost plus price.
cost based pricing is a second item. So this cost based pricing is the pricing strategy where the management sets the selling price by determining the total cost involved in producing that product or service, okay. So we are
Mm.
producing a product, so what is the cost on that, okay. So cost
Okay.
plus cost plus pricing means a fixed monetary amount is added to the product's cost to arrive at a selling price, to arrive the selling price. So selling price is equal
Yes.
to cost price, cost, the cost plus some value addition we will add. A fixed monetary amount. A fixed monetary amount we will add to get this selling price, right? Because this cost based pricing involves the where the management is setting the selling price by determining the total cost involved in producing a product or preparing a product or service for sale, and then adding a marginal. This addition is nothing but margin or a marginal value to the cost. Second is makeup price or markup price. Okay, markup pricing. So markup pricing is a percentage of cost is added to the markup to determine the price. A percentage we will add to the markup to add to cost. Add a percentage of cost, a percentage of cost added as a markup, added as a markup. So in this case we are not comparing with the competitors, right? Only we are doing
Yes.
based on our costs, right? Correct na? We are only
Correct,
doing
sir.
based on our cost. So markup can be applied. This markup price can
Sir,
be applied.
markup is the fixed percentage, sir.
Yeah, markup is a fixed percentage. We will add a
Okay.
fixed
And that is
percentage. Yeah.
decided by the management. But when we are seeing cost plus pricing, the cost plus the amount, margin. Margin means what, sir? Like it is like margin of
Contribution
marginal
margin. We are
revenue,
estimating a contribution
the
margin.
contribution
It's just
margin.
like a contribution margin. Huh? We are expecting a
But
contribution margin.
yes,
We
sir,
need to earn that much. Yeah, ask me.
that much. Like sir, we had to do in some the contribution margin plus added profit. That type of contribution margin we are adding, sir, here.
Yes. Yes. Yeah. Next.
So that only I was asking, sir.
Yeah. The markup can be applied in two ways. One is as a percentage of cost and as a percentage of what? Selling price. Okay. As a percentage of selling price.
Selling price.
So simple, the product cost into 1 plus a percentage. So markup
Sir, sir, the
percentage.
network is getting break, sir. Hello?
Yeah, can you
Sir,
hear me now?
sir,
Yeah, can you hear
sir,
me now?
internet, no, sir, internet is going in between.
Okay. So product cost 1 plus makeup percentage, markup percentage. See, one is the cost of the product plus adding some
Yes,
percentage.
sir.
And second one, the price here is equal to, this is the price we are calculating, is equal to price. Okay. Then for this price,
Yes, sir.
selling price as a percentage of selling price, we are applying markup can be applied in two ways. Now, the second way is
Yes.
product cost divided by 1 minus markup percentage. 1 minus markup percentage. What is the meaning here? Means as a percentage of selling price, the price is set by dividing a product cost by 1 minus makeup percentage, right? This approach
Sir,
helps ensure that all the costs are covered while achieving the target profits, right?
okay.
Yeah.
Sir,
Then we consider a formula for cost plus pricing method. We will take one few numbers. You remember this formula, and I will explain you how it is happening for both the methods. Now, example we are considering cost to produce and selling an item 70 per unit. Cost to produce and selling the item $70 per unit, and markup is 60%. Okay, so what is the markup?
Okay, sir.
60% is the markup.
60%.
Okay, what is the
Sir,
product cost?
okay.
Cost to produce and sell the item is $70, right?
Okay,
Cost
sir.
to produce, the production is happening for what? And
$70.
sell the item is equal to $70. So this is the product cost, correct?
Yes,
Two
correct, sir.
cases we need to apply formula, and we will get different prices because the formulas are different, the methodology is different, right?
Right, sir.
So we are going to calculate the sales price per unit if the markup is set as a percentage. Okay, if the markup is
Okay, sir.
set as a percentage. So first one, the first method, first formula we will apply
Hmm.
this formula. Then the price
Yes,
is equal
70.
to
Yes, sir. 70
70
into 1
into
plus 0.
1
6.
plus 60 percentage means 0.6
0.6.
is equal to $112, right?
Yes, sir. $112.
Remember this point. And second formula we are applying, product price is equal to PC $70 product cost divided by 1 minus 0.6 is equal to $70 divided by 0.4, correct?
0.4.
In percentages,
0.4.
in percentage, right?
175, sir.
So it is
Yes, in
$175. So if you are applying the
$175.
sale as a percentage of selling price, as a percentage of selling price,
Hmm.
and as a percentage of cost, right?
Right, sir.
So what you understand, the profit is higher when the makeup is set as a percentage of selling price, right?
Yes,
So the conclusion
yes.
is the profit is higher when the profit is higher when this method means as a percentage of selling price, as a percentage of selling price, right? Resulting in a price of 175
Right.
compared to when its price set as a cost, the price is 112, right? Now you can
42, sir.
see below, profit is higher as a percentage of selling price than the percentage of cost if you use.
Cost.
So in this case,
Yes.
price is equal to 175 for as a percentage of selling price. Then you can see 105 is the markup price, higher profits you are receiving. So the profit is higher, when the markup is set as a percentage of selling price compared to
Hmm.
when it's set as a percentage of cost. So 45 and
Yes,
105. Understand?
yes.
So which
Understood.
method you will use, it is
Sir,
depends upon you.
so then why company should always go with selling price method? Now they will get higher profit.
So then there is a problem of competitor prices again. If you make the if you
Yes.
decide more prices, it is not possible to sell your product, right?
Hmm.
So this is the
Right,
managerial
sir.
analysis. Now it's a managerial analysis. You need to concentrate on the value reflection, external factors, and also cost. You need to cover your cost. First problem is, the first
Hmm.
idea is you need to cover your all the cost, rights, cover your
Right.
cost, because you are doing business to cover your cost and earning the profit. And if you want to cover the cost, and if you add more markup, if you want to add more margins, then it will be higher prices. Okay, if you add higher markup, it's a more markup, higher prices. When you are going to sell in the market, it is not possible to sell because you need to fix a price which is similar to your competitors, right? Comparable.
Yes.
Comparable with
Right.
your competitors. Understand? And if you are comparing with
Correct,
the
sir.
competitors,
Understood.
you need to cover your cost again. So in between this, covering your cost is important to you, and you need to fix the price to cover your costs, as well as you need to compare those prices must be available to the customers and comparable to the customers with the competitor prices. Two
Yes,
things you
sir.
need to apply your managerial decisions, because market based approaches are really market based pricing approaches, and comparison based and cost based, both are important. Okay,
Hmm.
so now we need
Sir,
to
so
ask that what
nicely
is the
you
difference between
explained.
these two. So market based pricing approaches involves setting prices by referring the competitor prices, right?
Yes, sir.
And means here competitive markets are that standardized product. Competitive markets means especially in high competitive commodities like markets where the companies focus on the cost leadership. And standardized product, companies can set a price at market rate if the products are similar to those offered by the competitors. Like that I said, told you, Maggie and Ippi noodles. So these two
Yes, sir.
companies are similar, identical. If one product is not available, immediately the buyer shift to another
The
one. So the
shift to
prices
another
should be
one.
standardized pricing. Okay,
Standardized version. Okay.
now comparison in between these two, both approaches can be used in the markets characterized by the product differentiation. Understand? If you are
Okay.
going for the market based pricing, start with the prices established by the market. Okay, then
Hmm.
start with the market prices, correct? So starts with the prices established by the market, so market prices needs to be considered. So this cost based approach only concentrate on your cost of production. Okay, because
Yes.
why you are
The
concentrating on cost of production? Because
because
nobody is
I'm
there na,
adding a
nobody is a similar competitor for you. You can do it. You
okay
can fix the prices according to your cost recovery, right?
monopoly market.
That not only monopoly, not only exactly monopoly, because monopoly is different here. So you don't have a similar products. Some products are there, but example is there. So instant noodles are available in the market, but no instant noodles are available. Example, no
Yes.
instant noodles are available.
Example.
Okay,
Correct, sir.
so the
Okay, sir.
people who are searching for instant noodles, then they will go and buy the instant noodles directly. There is no
Instant noodle.
comparison at all, right?
Yes.
So in this
Right,
case,
sir.
you need to concentrate only on the cost, and here you need to concentrate on market prices. Because if you are thinking about there is a similar products are available, if you are concentrating on the uh, cost of production, it is not works out you, right?
Yes, sir.
Now so here later you start concentrating market based pricing. First is the market prices need to be considered. Second one is works backward to determine the cost of production. Work backward. So after deciding the price, you go back and
Sir,
decide the
then
cost, right?
this is that sir selling price method which we had done.
Mm. Yeah, yes, market, the first one, market approach,
Okay.
market based approach, comparables, the first one we are talking.
Market based approach is following the selling price method, sir, where we had back went and calculated the from
Yeah,
the selling price we deducted the
yes,
cost.
yes.
Sorry, not the cost, markup.
Mm.
Hmm.
So market based pricing, we are starting with the market price, and after deciding the market price, so means you are able to sell at $12 per unit. Understand? Because similarly the
Yes, sir.
other company is also selling the product at $12. So market price you determine, then you are going for the cost. So works backward, going back to the cost and determine the production cost need to achieve the
Hmm.
company's target profit. So you are expecting a target
Understood,
profit
sir.
of $2 per unit, which is 20% on the sales price. Then
So
now,
I have to
could
fix.
you able
So
to
my
could you
cost is constant till $10.
yeah,
Hmm.
could you able to produce a product at $10? That is your question.
Yes,
So works
yes,
background to
I can.
backward to
Hmm.
determine the production cost need to achieve the company's target profit. This approach is driven by external market conditions and competitor pricing. External external
Market condition and
reference
competitor
point.
pricing.
External reference point. Point 1A. Right?
Yes.
So the second one is this comparable the second one is cost
Based
based
on the cost,
in the cost
I am
based.
determining my
So
selling
we
price.
are just adding, we know the cost of
Adding.
production, we are just adding our desired profits or target profit. Okay,
Hmm.
target
Okay.
profits we are adding. So
Yes.
adds a desired profit margin to arrive at the final selling price, adding, and you will find the final selling price of the product, right? But in
Right,
this
sir.
first case, market based, already selling price is first decided based on the competitors. Then you find out your cost, and in the in the cost based approach, first you are doing with the cost and adding the target profits. So this is backward selling price to cost, and this is forward cost price to selling price. Done. Clear?
Done. Sir, clear. Sir, can you just go little bit up? I want to just see one thing in that sum. Done.
The second concept is, the next concept is target costing concept. So target costing means you are targeting the costing, means your costing should be minimal or lower than your cost you find it out, you calculated. See, target cost is equal to this should not maximum with the tax, the cost should be less than this target cost. So you have a competitor prices. So the competitor price is $12, and the desired profits are, you are expecting $2 is the desired profit you are expecting. So your target price must be lower than $10, right? So this approach
Okay. Yes,
sets a
sir.
maximum allowable cost. This is the maximum allowable cost for you to earn the $2 profit, right? So this approach sets a
Right, sir.
maximum allowable cost for production based on the market price and the company's profit goal. This is the competitor market price. You can say market price minus target profits. Okay, not total production, target profits, desired profits. So simple, na? First you need to determine competitive market price. After that you determine your desired profits. Then compute the target cost and
Hmm.
use value engineering techniques. Use some of the techniques. What are the costing techniques are there? What are the production techniques are there? You apply all the managerial and operational techniques to meet your target cost without compromising the product quality and functionality. Don't compromise in your, means use successful, I mean quality raw material, use great functionality to production of goods and services, and apply clear operation techniques to meet the target cost without compromising the quality. So
Sir, this is called value engineering.
yes, value engineering. Use value engineering techniques.
Value engineering techniques.
Okay, use your value engineering to techniques
Okay.
to minimize the cost
Okay.
within the target cost. Okay,
Okay, sir.
so now another one is, you can also apply Kaizen costing.
Kaizen, sir.
Yeah.
Kaizen
So
costing.
this is implement continuous cost reduction methods, including negotiations with your raw material suppliers, and tighten your operation controls to keep cost within the target. So bargaining, negotiations with your raw material suppliers. This is important, right? And another
Right.
one, apply operational controls, tighten your operational controls, tighter operational controls, you can minimize your cost. Operation controls. Understand the logic?
Yes.
So you apply all your value
Control.
engineering techniques or Kaizen
Understand.
costing methods or any other thing to bring the cost to minimum level. So this approach ensures the every company can offer competitive pricing products while maintaining the profitability and operational efficiency. So based on this concept, the ITC enter into the noodles market after the Maggi noodles, right?
Maggi
After
noodles.
the
Yes.
Maggi noodles in the market. So Ippy noodles are also applied the same concept. They adapted the competitor pricing model, and while maintaining their profitability and operational efficiency, they can able to produce the products and they are achieving their targeted costs. Right?
Sir, but there is okay.
Now the value engineering topic is systematic approach to improve a product's value by evaluating all activities along its value chain. The method focuses on enhancing the product quality while reducing the cost by identifying and eliminating unnecessary activities. The most important principles of value adding, one is enhancing the value, means adding activities. You are enhancing the value or quality of the product by adding activities, means more efficient essential functions you are managing to meet the customer satisfaction and customer needs, and you are prioritizing the quality and increasing the value of the product and quality to the product. These might include high quality materials you are using, innovative features you are adapting to produce the product at lower cost and giving the good quality, right? The B point is eliminating non value adding activities that do not contribute to the product's value. You are adding which are adding to the product value. You are eliminating which are not uh,
Not
creating or not giving any value to the
creating
product.
value activities. Yes,
Okay.
like reducing packaging labors and
Yeah,
all. Yes, sir.
reducing packages, expensive packaging we are
Hmm.
reducing,
Expensive.
inefficiency in the production we are reducing, unwanted production
Yes.
process are there, those we are eliminating. Okay.
Yes, sir.
Understand?
Okay, sir.
Very good.
Understand.
Now third point is, can you tell me the third point?
Application in target costing. Sir, we will only target on our production. Like, sir, if we have to produce within $10, so we have to target that, and we have to talk with our raw. We will calculate how much raw material we will use, how much labor we will use, how much indirect labor or direct labor, direct material. Means, sir, variable costing part we'll have the control, and we'll
Yes.
try to manufacture within the the backward calculation we have done now, sir. From selling price we have reducted the profit, and then we are seeing how much cost I can incur. I'll not cross my borderline, then I'll not have my targeted profit.
Means,
So I will synchronize my hands on variable costing, sir. Try to use minimum of minimum costing to give the greater value products at my targeted profit.
yes. So simply, value engineering is a critical tool in target costing.
Oh,
By managing
target.
and adjusting product cost, companies, the management can ensure they meet or stay below the target cost established for the profitability. They helps in creating a competitive and cost efficient product without sacrificing the quality of the product, right?
Quality of the product.
So means
Yes.
removing the wasteful expenditure and adding the activities directly contribute to the customer value, we will adopt. So this is a streamline the production process is most important for the companies to achieve the targets. Costs means producing it, minimizing the cost and maximizing the profits and giving the high quality products. Or if you are giving the high quality products, the price will go up, but the thing is giving the high quality products at reasonable competitor,
At
within the
reasonable
reasonable competitive prices.
yes,
Okay.
sir.
Right. So you are understanding, right, clearly?
Yes, sir. Clear.
Nice.